We're now starting the next technical session titled Nano Enterprise Lending, Insights on Borrower Profiles. It is my privilege to invite the esteemed panelists of this session, the moderator, Ms. Geeta Goel, Country Director of MSDF. Let's give her a warm round of applause. Our lead presenter, ladies and gentlemen, is Abhishek Gupta. IFMR lead speakers are Shweta Aprameya, founder and CEO of Our Impact, Mayur Modi, co-founder and co-CEO of Moneybox, and Puneet Gupta, founder of Kaleidofin. Smita Premchandar, founder of Sampark. Let's give them a round of applause, ladies and gentlemen. After that wonderful lunch, I think we need to give them a real good round of applause. Thank you. So we look forward to the session, ma'am. I'm handing you over to the moderator, Ms. Geeta Goel, Country Director of MSDF. And we have a time duration for the session. Kindly be on time because we're already starting very late and we don't want to be late for all the other sessions. Over to you, ma'am.
Okay, I know this is a post-lunch session, so we will try and make it interactive, but I will get to the panelists later. We do have a presentation to kick us off from Abhishek. Abhishek, you want to come up and Abhishek will talk about it, but I guess the panel is really structured around nano enterprises, which we feel is a good segment within MSME for us to focus on. It is a segment that does get missed out in the larger dialogue on MSME. And Abhishek will lead us through some of the findings that we've had as we've looked at this sector.
Okay. Hi, everyone. Am I audible at the back? Okay, cool. I'll begin the presentation. This is impact investment of Michael and Susan Dial Foundation's NBFC portfolios in India. They provide lending to nano enterprises. So IFMR is sort of conducting a 3-year impact evaluation. We are at the midway of this project, and sort of regarding the release of the report we've gathered here. I'll just quickly sort of describe about the nano enterprises. Am I audible? Okay. I mean, we all know about MSMEs. Within that MSMEs, we know that micro enterprises comprise the majority of the enterprises. And even within micro enterprises, most of the enterprises are below INR 1 crore annual turnover. So that's why we're defining this as a specific segment, that these are nano enterprises which deserve specific attention. And by the way of this forum, we want to draw attention of all the stakeholders, financial service providers, and the policymakers to focus on this particular segment of nano enterprises which have an annual turnover less than 1 crore. Another qualitative dimension of these enterprises is about their ubiquitous hyperlocalness. These are mom and pop shops, these are your neighborhood stores, small businesses which are run in any neighborhood across India in different parts. So the reason for this study and the importance of this study arises in the fact that we already know there is an access to finance gap. All the studies have shown that. We also know what is the immediate impact of the access to finance for these enterprises. If you provide credit to them, they will make an investment in raw material or some equipment. But the impact is not sort of measured in the form of a long-term change in the enterprise finances as well as in the household income. So this study is designed as a pre-post study sort of to understand the journey of a nano enterprise over the loan cycle. This is a sort of a snapshot of the way the study is conceptualized. This is the baseline survey, midline, endline, and a small post-endline survey. We are also collecting the supply side data from the lenders as well. For example, a loan is dispersed somewhere here, then we do a midline here, then we do an endline here. So we are at this stage right now and releasing this baseline report. These are the themes tracked in it. Three major themes: business performance, employment, well-being, and two softer dimensions of entrepreneurship and formalization. This is a sample size, 2250 nano enterprise borrowers of 7 NBFCs sourced from 7 states in India and 170 districts, spread across 170 districts. The ticket size, as per Dell Foundation's mandate, we've chosen as INR 40K to 4 lakh. This is a segment which is slightly above the microfinance segment. The loan duration would be of 12 to 24 months. So it's a 1-year tenure loan and a 2-year tenure loans. Majority of them are 2-year tenure loans. Coming to the sort of the major part regarding which we'll have a panel discussion today, the baseline findings. The annual turnover, the median annual turnover is around 5 lakh in this study across this 2250 customers. For the sake of analysis, right now we've chosen the tertile classes, 33% each, as a way of segmenting them. Based on that, we arrive at the following cuts. INR 3 lakh, those enterprises which have a turnover below 3 lakh, 3 to 10, and above 10. This is an important slide to consider. Sort of what we are finding is that majority of the loans are skewed towards a sort of a range less than 2 lakh rupees. So remember in the previous slide we talked about that we go up to INR 4 lakh rupees, but if you see that this part, it's pretty less. So majority of the loans are below 2 lakh rupees. There can be a couple of reasons for it. One is that the enterprises seek very short-term, very fast processed working capital loans. Another part can be that the financial institutions are reluctant to lend a sort of a large sum to sort of these enterprises, or it can be both as well. And I think that is a question for panel to discuss today. I'll go to the next one. The median monthly household income is INR 40,000, which, by the way of analysis, as per the CMIE data, as well as World Bank and price data, it would comprise the middle income group in India. So middle income group is from 25,000 rupees to 50,000 rupees in India, and at a median monthly income of 40,000, this would be in that range. Important factor to note is that most of them have a additional source of income here. 84% sort of have another source of income, either their own, or they would have somebody else in the family working in, either in form of an agricultural income or rental income or some other enterprise. Also tied to this fact is that this particular enterprise for which they have taken a loan, it comprises 60% of their household income. So a large part of their income of the household is coming from this enterprise for which they have taken a loan, and that's why this enterprise is central to these nano enterprise households. We can see that across the three segments, it rises from 47% to 68%, which means there is an increasing specialization as sort of the turnover is increasing. More and more households are devoting themselves to one particular activity and specializing in that, and that's why it is sort of increasing from 47 to 68%. Next bit, it's the operational characteristics of these enterprises. Interestingly, the median vintage has been sort of 7 years. That means these enterprises have been in existence for a while. It's not as if they've been just established in the last couple of years. Also tied to this fact is the point that sort of more than 70% of them are first-generation entrepreneurs. So these are not the enterprises which have been passed on from the family, passed on within family in the majority of the cases. Majority of the cases, these enterprises have been self-set up with a median vintage of 7 years. And that also means that the lenders are providing credit to enterprises which have been in existence for some time. And importantly, I think this is an important dimension we captured based on sort of inspired from the NSS 73rd round. We want to capture where are these enterprises located. So we know that from our survey, 55%, that is more than half of the sample, is actually applying from commercial places. 33% are working from home, but 55% are based in commercial premises. That ties back to the initial point I was mentioning about the hyper-local character of these businesses. These are mom and pop shops based in commercial spaces, commercial market spaces. In terms of registration, it's a little disheartening to know that 60% are completely unregistered. So they are located outside of home. They have a vintage of 7 years, but 60% of them are unregistered, completely unregistered. They don't have an operating license. They don't have an administrative license. And of course, Udyam and GST are also not there in these cases. Only 16% have a Udyam registration license. One silver lining, perhaps, 43% in one of the segment, the highest segment, have a GST registration, which effectively is sort of consistent with the larger macro picture because GST is applicable to enterprises more than 40 lakh annual turnover. The last bit, I think this is important for this audience here, this forum. We talk of the digitization aspect, but we have to keep in mind that only 58% of the people in the sample are either sending or receiving a digital payments. 40% people are still outside of the digital payments fold altogether. They haven't either made or received a digital payment. So this is an important point to note, keeping in mind that 80% do have a smartphone. By the way of digital payments, here we do not confuse it with the agent networks and business correspondence. This is self-mode digital payments of UPI and digital wallets and debit cards. And consistent with the larger sort of scheme, we know 66% in the highest segment will have a digital payment flow daily compared to 22%. So as your enterprise grows, your digital share also grows. This is the heart of the survey and will be tracked for next 2 years as well. We are capturing the enterprise finance statement since it is central to the impact evaluation. I'll first go vertically and then I'll go horizontally. So what we see vertically is that raw material expenses are incurred by majority of the enterprises, 1647 out of 2250. As compared to the other sort of rest, it is in the descending order. An important result which I could take away from this was on the rental part. I think there has been very little discourse on this dimension. Since these are commercial enterprises based out of commercial premises, they pay rent. And there is a rental outflow which happens for them. Over 1,000 enterprises are paying rent. And there is clearly a sort of a missing market here for affordable commercial premises. I'll go horizontally now just to see what is the state of affairs across the three segments. So we see that yeah, I'll just quickly wrap up. Yeah. Okay, cool. So this is again, just to wrap up the presentation, 33% of the enterprises have one worker. At least, that means 67% do not have any workers at all, and this would be tracked during the during next 1.5 years. The average wage is 10,000. This is in line with the periodic labor force survey data. Importantly, something for panel to discuss, 90% of the enterprises do not plan to hire in next 3 months, which needs to be discussed. This is the last slide. We've made a distinction between microfinance NBFCs and non-microfinance NBFCs. What we're saying is that what we're finding is that the men and the women-run enterprises are just about similar, sort of in the microfinance category, whereas there is a difference between men and women in the NBFC2 category. Specifically, I want to point out this particular aspect. There is a sort of a yawning gap between the digital adoption between men and women-run enterprises in India. That is about it. I'll hand over to Geeta for a detailed discussion on the subject. Thank you so much. Thank you. Thank you.
Thank you, Abhishek. And there are a lot more details in the report, which we will actually we do have some copies around, and it's also available on the website. But I would just take 2 minutes to say the reason we started doing this detailed exercise was to say, again, we talk of 65 million, 63 million MSMEs in India contributing significantly to GDP, contributing significantly to employment. And yet, when you drill down, there was very limited data on what are the different type of enterprises within this segment. Micro constitutes 99%, but that's all enterprises which have a turnover of up to 5 crores. So saying, is there a segment within this which is still fairly underserved but seems addressable? So, and that's where we came up with the definition of saying nano enterprises, annual turnovers of 10 lakhs to 1 crore. A lot of the portfolio companies that the foundation supports today uh, are supporting these nano enterprises. And this, I would say, is the first step from our side to say, let's start getting some data out on this segment. Only when we understand the segment can we service the needs of this segment. And it's great to have the panel here, some of which or most of which have been working with MSDF over the last few years. But again, saying that, the nano segment is a 10 million odd segment, and less than 5% of it seems to be today covered by formal credit. So there's a long way to go. The idea of, I guess, the findings was, and Abhishek could not present a couple of findings, and I'll love the panel to talk about. We still find the new to credit representation in the portfolio to be fairly small. So it's all like 25% odd, saying that, despite data, despite technology, despite NBFCs focused on this segment, we are not getting to new to credit. So I would love for the panel to, also take that into account. I guess the second thing is we are still finding loan sizes to be fairly small and not increasing despite the increase in the turnover of the company. They're very standard loan products, limited, customization of product. And again, so as you go through, how we, and then, the third is, Abhishek referred to the digital penetration and digital payments, but still, even with nano enterprises which are using some digital payments, like I would say less than 10% of all their transactions would be digital on an average, which means that a lot of their transactions do not have history, and it's difficult to do the cash flow assessments. So keeping those in mind, I would actually open up to the panel. I will not do detailed introductions. I think the MC announced everybody's names. What I would do is, as you open, Shweta, and I'll start with you. If you could talk a little bit about the work that you're doing in this space. Do you feel, the nano definition of 10 lakh to 1 crore is okay? Is that a distinct segment? What percentage of your customers fall into that segment? What is the current size? And recognizing that it's a very underserved segment, what is it that you are doing as an organization to really unlock credit? So we could do quick 2 to 3 minutes introductions and then come to some of the questions.
Thank you, Geeta, and thanks a lot, Abhishek, for sharing the notes on the report. Firstly, I'd like to mention here that everything that Abhishek just spoke about really resonates with the customer segment that we have at Earth. We started our journey 4 years back. We are a fintech micro MSME startup. We focus largely on nano and small businesses across India. We are a leading financial product platform. And since the last 4 years, we've had tremendous learning, everything that Abhishek was pointing out to say that there is a new to credit challenge, there is a challenge around ticket size, digitization, etc. But what we've also figured out is the opportunity within the segment and the resilience of the segment to grow. And rightly so, as Geeta pointed out, this is going to be a key pillar in the entire economic growth of the nation. And expectedly by 2025, it's going to contribute 50%. So it's very, very important that everybody really takes a good look at what's going to happen in the nano and the small category. And from our perspective, there are a couple of very insightful pieces that we've been able to figure out, especially last 2 years in COVID. One is that from this customer standpoint, while there is a view to say that there's lack of information, the lack of information is a view because we are not really reaching out to the customer. So at Earth, we started defining ourselves as an active finance partner. And we said that if we really need to understand this customer, we really have to source information and source data. That's the starting point. So our theory really starts with saying that an active finance model is needed. And our model is built on the premise of, as we call it, the three C's. One is what we call as coverage. So many customers, 63 million, maybe even more, so many of them unregistered. How do you know them? Find a way, a distribution strategy to reach out to as many customers as possible to increase coverage. One is that. Second is, how do you increase coverage of capturing data and capturing information? How do you build partnerships at a hyper local level, at a grassroots level, to be able to acquire sensible, reliable data which you can then process? As a company, we've processed over 1 billion data points of 1 million customers and given 5 lakh loans already to the same new to credit, to the same nano and small business. So if we can do it, we think there is a progressive way of really scaling this up. The second piece is very, very important, is the care part, which the way we look at it from a solutioning standpoint is to say that, okay, if you have coverage, you've got information data to understand whether credit is needed at that point in time, payments is needed, or insurance is needed. The most important aspect about a small business owner is to understand the events of vulnerability, because if you don't take that into consideration as a financial service provider, you will get into a situation later on. So we have been thinking about a model of care which talks about understand the vulnerability events, sensitivity events at a customer level, at a market level, and work around those scenarios. So good example is insurance comes in. If it's at a customer level, do you do EMI protection? Very important product. Similarly, at a market or a systemic level, when COVID happened, working with stakeholders like MSDF, really thinking about softer capital to come in to provide for slow payers, businesses that were shut down, etc. So that's the care element around it. The third aspect of active financing, which is the solution itself, is community. We will have to, even as a fintech, have to work within the communities, which means activating tools for nano and small businesses. Simple things like upskilling, simple things like information access. Third is payment services. So we as a company have also already deployed 1,000 payment solutions across our customer segments, and we are growing that number day by day. By March ending, we will have 5,000 earth pay points already facilitated. So these are things which, is not about having a very low thin relationship, but actually solving for everything that was being highlighted, to say that information, digitization, right product, the timing of it being right, has to be thought through. And at Earth, that's what we are trying to solution for as an active financing model around coverage, care, and community. And that, of course, is possible with a very deep tech. That's not a important information in this forum, but all of this we are enabling through a complete tech platform. And we've already touched about 3,70,000 unique customers across 18,000 pin codes. So scale is possible. It's happening as we speak, and hopefully with what we learned today, we will continue to grow. So over to you, Geeta.
Thank you, Geeta. Thank you so much for having me here. So myself and my other co-founder Deepak, we started Moneybox around 4 years back, 2019, and the idea of starting that was obviously kind of address this huge gap, as everybody else is trying to address the missing middle, or the micro entrepreneurs as we talk about. We kind of touching the the starting base of the micro entrepreneurs, or the nano enterprises, as we can define that, in the 10 to 12 lakh turnover category. Uh, so we started this journey in 2019 from Rajasthan, and today, as we speak, we are present in 6 states across North and Central India. Created a portfolio of around 400 crores, uh, and kind of funded 40,000 individual borrowers. Um, all and out of that, as you were mentioning about the new to credit, almost 40% of the borrowers that we fund today are new to credit, coming for the first time into the formal financing. So that's very heartening to see, and we take a lot of pride in kind of funding them NTC. So what compared to what Earth does, I think we've taken a slightly different approach in terms of underwriting. We feel that the segment that we cater to, which is the MFI plus plus, a lot of our customers are customers who have had some kind of exposure to MFI, and now they are in need of a high ticket size, let's say 1 lakh, 2 lakh, 3 lakh rupees, and they find it very difficult to find that lender who can fund them. So that's where we come in, and then kind of try and assess the cash flow model. And for that, we feel that being closer to the customer is very important. We tried very early in the journey to do it pure fintech. I think that's something that we couldn't do. We realized very early in the journey that a lot of our customers have no banking data. They have no transactions which can be traced back digitally, and a lot of these transactions are happening in cash. Whilst after COVID, we've seen a lot of transactions moving digitally, but still 80 to 85% of the transactions happens in cash. And for that, you need to be present closer to the customers. And that's the reason we've kind of, embarked on this hybrid model where we are physically present closer to the customer segment. But once we touch base with the customer, all the processes is digitized in terms of the flow of transactions, assessment, and then the repayments and the collections part. So we kind of created this hybrid model. What is the most challenging and the most difficult part in understanding this segment is I think a lack of education, a lack of financial literacy amongst these customers. Whilst there are products and kind of services available, a lot of governmental schemes available, I think understanding of these schemes, understanding of how to avail these schemes is purely missing. And we include with lending a lot of educational programs in our lending business. For example, what we did early in our journey is that we started hiring vet doctors in our branches. And the sole purpose of these vet doctors was to kind of educate the customers, the cattle owners, in terms of what is the kind of feedstock that you need to give to your cattle, what are the different vaccinations that you need to avail, what are some of the insurance programs available from the government. So a lot of these activities we do doorstep free of cost to these customers, which really help them in managing their businesses better, and in turn helps us in terms of educating them and then bringing them up to speed. We have also done a lot of agroforestry activities with them, with our CSR partners, basically planting fruit-bearing trees for them.
Sorry, I'm conscious
Yeah, yeah,
of
I'm so
time.
sorry. So there's a lot to talk about, but we'll talk about it in some time.
But I do want
Yeah.
you, and maybe the next time it comes to you, it would be good to also talk about. I mean, since you mentioned formalization, and like a lot of their transactions are not on digital platforms, but once they take a loan from you, do you see an increase in digital transactions from their end? Because at least the payments they make to you would be on through internet, I mean through online channels.
That's there. I think
So
there is a huge adoption once they get to know that this is something that is really beneficial to them, and this will help them build their credit profile, and will help them kind of take a loan in future which is higher ticket size and from a
So I
from
would
a
love to see if you estimate that if 10% of their transactions were earlier online, now post it becomes 30%, 50%,
so
70%.
at least 30 to 40% is now digital. Yeah, yeah.
Okay. Puneet, over to you. I mean, I guess what we heard both from Shweta and Mayur is that they both have phygital challenge of reaching the customer. So both tech is important, but the touch points are also important. It is still a significantly cash driven assessment. Uh, and and I know you are trying to do things at a different scale, so would love to see how you are trying to address some of the challenges, both on NTC, both first-time customers as well as informal customers.
Thank you, Geeta. Good afternoon, everybody. Thank you so much for having me here. I'm Puneet. I'm one of the co-founders at Kaleidofin. We are a fintech platform which is largely focused on working towards offering better financial solutions to customers, be it on the credit side, savings side, or insurance side. One of the big challenges that we started to look at was that customers were getting loans through microfinance, and which is an important service. Uh, but unfortunately, very hard for a customer to get a loan as an individual. There was still something that was preventing any individual from growing and raising their hand to say, I want a loan, and to be able to get that loan at all. And as a country, we've had microfinance history for the last 20 years. So one of the large focuses for us was that, is there a way in which over a period of time we can transform customers to start to use smartphone as a channel, as a channel, and then really start to take and access much better financial services through that particular channel. Uh, that's a problem that is easier said than done. Of course, in theory, one can argue that we have Jandhan, we have Aadhaar for everybody, smartphone penetration is increasing, but to design a solution is a completely different ballgame here. So one of the key focuses for us was, can we start to underwrite this customer? And knowing the fact that a lot of our customers could be thin file, or let's say the majority of data that is available is, let's say, only for microfinance lending. How do we transform that data into data that allows us to, let's say, give out a loan to a nano entrepreneur? And I'm largely focused on loans which are, let's say, between 100,000 rupees to 500,000 rupees. Uh, the answer to us came in the form of a very strong credit scoring model. We built something called Chi-Score. This has now been used by 16 different NBFCs and microfinance companies. Has been used to underwrite over 8,500 crores in loans. Very happy to report that over 5,500 crores of these loans are loan sizes of greater than 1 lakh rupees. A lot of these loans were given right after the COVID first wave hit. So this has seen wave 2, wave 3. Several of these loans have now been completely repaid, and we see a on-time collection efficiency of 98.8%. Uh, so that was basically one part of trying to say that how do you start to underwrite loans and how do you get to a place where a lot of the information gaps which seem to kind of prevent entities from being lending to this particular customer segment starts to become easier and more transparent. The second challenge is that how do you get the markets to work for it? There is also this entire piece of market infrastructure. When you look at micro loans, most banks today have a very clearly established micro loans policy. Uh, when you get into nano enterprises, we still have one common policy, which is with the MSME segment, and that actually gets very little focus, therefore, to come to this segment, which is between 1 to 5 lakh rupees, largely unsecured. So there, what we have done as an entity is to work on a very strong platform where we get lenders on board, and that allows us to be able to make sure that not only do we have a product that can be underwritten for a customer, but we also have a financer at the back end, which can actually start to make a lot of this to work out. So a lot of the focus that we've really put is on making the entire chain visible.
Sorry, and one follow-up question. Given you're working with a lot of microfinance graduating customers, they already have some credit score, because they've been in the system. But if you want to address the point around product customization and the fact that, many of these customers might be taking small loans from 3 or 4 different lenders because one lender is not giving them the full amount.
Yeah, so I think the ultimate question still comes to, can we underwrite the customer at all? In a lot of situations, what we found is that customers were able to take 100,000 rupee loans by borrowing from 3 different microfinance companies. But what that entails is a much higher EMI outflow because the tenors remain same and the customer is now just borrowed 3 different loans. On the other hand, getting a single loan with even a 1 year increase in tenor starts to reduce the EMI and the riskiness of the enterprise quite dramatically. So a lot of the focus that we've put is to say that, can we genuinely start to work towards underwriting this customer? That's really at the core of this entire place. And I can get into a little bit more detail later on of how do you get to building the data towards this. Uh, so one part where a customer has graduated from microfinance, there is actually already data available about repayment from microcredit loans. And it may not be it may actually sound very obvious, but there's a wealth of information in the credit reports, even for a customer who has a microfinance hit. The second part is really new to credit customers, and I would say that that itself is an exciting journey for us. We typically found that 10 odd percent of our customers, 10 to 15% of our customers who are borrowing greater than 100,000 rupee loans have zero credit hit at all. And there again, we've tried to build lookalike models, which now have seen test of time, and they start to actually create a very kind of a good base to be able to underwrite such loans.
Over to you, Smita. I know you wear many hats, but and I think you do have a few slides. It would be, I guess, good to hear from you, both in terms of some of the supply side issues that you've seen in your work, and your views on how we can address some of it. So, would you want to go ahead?
Thank you. I have findings for you from a study that we did for Access and the World Bank. For a study that we did for Access and the World Bank, and that's not only about nano enterprises; it's also about women. And the issue was that how can we look at what are the supply side challenges that not enough women are getting individual loans. So it's very, very relevant to this session. One of the key things that we found was that, in terms of micro enterprises, women owned enterprises get about 20%. But when you move to small women owned enterprises, the proportion goes down to 5%. And then you move to medium, and women owned enterprises get 3% of the loans. So this is something that's, and there is a funding gap. The IFC calculated in 2014. Now, I don't know what the figures are now. But when IFC calculated the funding gap for women owned MSMEs, it was about 90 billion US dollars in India. India's gender gap, when you calculate gender gap, India's ranking is 150 out of 159, 89 countries. So we're very low on gender gap. So how do you create pathways of graduation and so on? When we looked at these, we spoke to about, sorry, I'll just put all this on. We spoke to about 22 financial institutions, and we asked them about whether they monitor at all what they are doing in terms of giving loans to women-owned businesses, individual businesses, not SHGs. And we found that there's a huge gap when you move from SHGs to individual enterprises. A lot of the banks and the financial institutions said SHGs is priority sector, so we do it. But when it comes to individual loans, we don't then worry about women or men. So you're roughly getting, NBFC, MFIs giving about 15% because that's allowed, that they give 15% individual loans. For everybody else, they did not want to calculate. So we made this spectrum. Are institutions gender agnostic? Please read gender blind. It's impolite to write gender blind in a report, so we wrote gender agnostic. But honestly, they are completely gender blind. Then there were organizations which were gender sensitive. They were doing some research and some, but not action. And really, on the right-hand side of the spectrum were gender transformative institutions. A lot of them didn't collect gender disaggregated data. They did not have strategies for outreach and communication. They did not have institutional policies and staff attitudes that were relevant for, that would give loans to women, individual businesses, and there was no non-financial service and linkage other than what was given by the government. So I think I will, and the risk assessment and appraisal processes were not women sensitive. These are all the things that were working against giving women individual loans, right? I'll stop here with the research study and come to my role. And I am on the board of NBFC Seeds. It's a relatively new company. It's not in the microfinance space. It's just in the space where individual, women are graduating and men are graduating to individual loans. And so it's 50,000 to 2 lakhs of ticket size, mostly informal businesses. Many of them are not registered at all. 30% clients are new to credit, and about 40% have other loans, not just seeds loans. Their current rejection rate is about 75% of the clients approached because the rigor is very high, the repayment rate is very good, so they have to do a lot of work on the front line. And the thing is that basically, if you're looking at individual loans, again, women's percentage, you have to, if you want to increase it, you have to work really hard. And so, not just for women, but also for increasing loans to nano sector, they plan to introduce customer apps. They want to improve credit appraisal tools. One of the most important things they want to do, which will lead to expansion in the nano sector, is to plan value chains and help these businesses to expand. And another thing that they plan to do is to do cluster development to extend outreach. So these are all their solutions going forward, and I hope that that contributes to some solutions that we can think of for the nano enterprise sector. Thank you.
Thank you, Smita. Okay, so I am also just conscious of time, and I do want to leave 10 minutes from any questions from the audience. So just after listening to all of you and the findings that Abhishek shared, I feel here is a group of people, and there are many more in the audience, I'm sure, who's trying to find solutions to unlock more credit to this segment and also market linkages, cluster development, etc. And this group is almost okay saying कि itna smartphone penetration hai, itna data transparency hai, we'll work around it and we'll find solutions. So you're not waiting when India goes 100% digital and all transactions. Uh, and and you're scaling up in your own ways, but just given the size of the market gap, there is a lot more to be done. So I guess the question for each of you is, and yeah, I did see Vipin here. I was also, yeah, there he is. And Brij Mohan ji is here. I saw Jayashree Ben there. I mean, there are a lot of people in the room who can also, I mean, what I'm about to ask you is like, what is one suggestion you would give if you were to, either change policy or any government scheme, or even the way the banking system works, so that, we can actually expand the market in a sustainable way, in a sensible way. And I was pointing out to all these people that, we have keen ears here who can take some of the suggestions forward. And I do think at least, there should be one or two strong actionables coming out of this group, which then we can take forward. So maybe, Shweta, do you want to begin? Yes, we'll go the same place.
Okay, so while the list is very long, Geeta, I will stay with one.
Yeah, you have one most important.
Okay, so I think given the last 3 years of experience and specifically during COVID, I think if I had one big ask, and thinking like an entrepreneur, of somebody similar who is also an entrepreneur, a nano or a small business owner, I think a concept of failure capital has to come in our ecosystem. And that failure capital has to be at a customer level, has to be at a business level, which basically means that if an entrepreneur, a small entrepreneur fails, how do we provide for support during that time? And it can happen to anybody, so we should have a framework and approach, especially dealing with credit, especially dealing with financial services, to say that can we create a policy framework to say that the answer is not moratorium, definitely not moratorium. The answer has to be an approach to failure capital. It could be soft, it could be whichever format, it could be subsidized. But I do hope that whether at a government level, ecosystem level, or at a multilateral level, we think about solutioning failure capital as a way to support credit to a customer, and also in a way to say that if you are unable to surpass the time, you have the right to set up another business. And how would you do that? Your bureau will not be affected. So the next time it should not be that you didn't get credit the next time because you failed. So I think that's my big ask, that is there a mechanism that we can draw down around failure
So
capital?
Shweta, would this failure capital be more like an insurance credit guarantee, and then you're also starting saying start afresh on credit
Yes,
ratings?
yes,
Okay,
yes, yes.
okay.
I think uh, what we lack is kind of whether you call it failure capital or risk capital. I think there's still a lot of reluctance on the banks, especially the public sector banks, and obviously private sector banks. But I think the role of public sector banks becomes more important because they provide a lot of capital to NBFCs like us. I think they still rely on a lot of traditional way of assessing a NBFC and providing capital, and they only do it out of to an extent compulsion to kind of get a PSL portfolio out of these NBFCs. I think somewhere that approach to this segment has to change, and either it is the governmental push or banks kind of form policies to kind of actively participate. Obviously banks can't go and do the lending, and we understand, because it's not lucrative for them, but there are a bunch of NBFCs who are ready to take that underwriting journey and underwrite these customers. But we need a lot of support from public sector banks coming very early in the journey and supporting us in funding some of these customers. I think that risk capital has to come in.
Okay. And I mean, just to again follow up on that, would it be fair to say that, today MSMEs do get covered under priority sector lending? So as such, the policy framework allows for it, and yet we are not seeing as much capital or as much debt from the banks to NBFCs. So again, maybe it is going to the larger
Larger
NBFCs,
ones.
maybe it is
True.
going towards the small and medium enterprise financing
Absolutely.
rather than the micro and the
Absolutely.
nano.
Absolutely.
So if there are
So,
sub-segments within that,
yes.
and also, I mean, I hear that a lot of the banks lend to, yeah, the AAA, and there's less
True.
banking capital available
Absolutely.
for the smaller
True.
NBFCs. And I know,
Yeah.
yes, Brijmohanji is here. SIDBI is also trying to do a lot of
Yeah.
initiatives around smaller NBFCs.
Geeta, I'm going to say two things. I was trying to kind of weigh one over the other, but can't really. So, one of the big challenges when we talk about nano enterprises is that working capital is just extremely hard to get. Most of the work that we do, customers are taking term loans and they're trying to basically use it for working capital finance. NBFCs are not allowed to offer any limit based financing or credit limits or multiple draws or working capital loans. And I would say that there is a need to be able to create more channels and rooms to be able to do this. It's completely fine to be able to put down ALM based criteria to be able to do this, but it is a critical need for the hour for us. If we were to be really financing nano enterprises, we need an ability to be able to do working capital finance. So I would say that's number one to me. Uh, the second part, which is again equally critical as we look at this, is the space for fintech companies to be able to innovate in this regard. I think there is a lot of conversations which are happening around digital lending, fintech guidelines, but really what is required is a way where fintech companies can work with established NBFCs, established banks, get into some kind of a risk share agreements to be able to try out new things in the market. We realize that ultimate source of funds is always going to be banks. NBFCs are not allowed to take deposits, which is actually a good thing. But what it therefore means is that there have to be more and more avenues for partnerships to happen as opposed to less. And I think it will go a long way if we were to have a proper fintech policy, which is based on principles of risk sharing with large pools of capital at the back end. So I would say these would be my two things. I would also add at the same time that the onus is also a lot on us as entrepreneurs. We need to create models which gives the confidence to bankers that we truly have an ability to be able to underwrite loans. I think the big challenge is that a lot of us have scorecards which need a lot of work. We are all operating in data environments which are not optimal. And therefore, a lot of the onus also is on us to be able to create models, create visibility around our work, to be able to give confidence to the entire ecosystem to be able to do a lot of this work. But the start has to be made by us.
Yeah, and talking about visibility, I know over lunch we were discussing that each of you said your new to credit customer portfolio is actually performing better than your credit exposed customers. So I mean, these are all nuggets which come from working with this segment, and the more we establish data around that. Smita, over to you.
So I will follow Puneet and say two things. One is that we still have to understand that digital and tech is all good, but the relationship with the client is still the most important factor for repayments. And I think that that social relationship which NBFCs form with the client at the at the time when the client is still in groups is somehow needs to be replicated when you go to the individual loans. And for that, even though fintech is trying and so, but and fintech works. Certainly, all the NBFCs are now beginning to use technology in very good ways, sometimes directly, sometimes in partnership, but there is no wishing away the individual client and the field officer relationship. And so that makes for cost, and that's something we have to look at. The second thing we have to look at is graduation pathways. It's not, we're still, even though there are lots of successes, but it's not as if we know a proper graduation pathway from self-help groups to individual loans to nano, and from micro to nano enterprises. That's something that still has to be developed, and because of that, policies are important. So I think still there is a need for government policies which will then enable not only incentives and guarantees to the financial institutions, formal financial institutions, but also gender segregated data and size segregated data, industry segregated data. We're not collecting and using data efficiently even now, not doing that. So I'll rest here. I think there's a huge amount of work to be done there.
Yeah, and I mean, I would say the starting point is actually, segmenting. I mean, so even before you start collecting, and that's why I guess this panel was also structured around nano enterprises. So even if we start calling that out, getting data on it, by industry, by gender, and then seeing the portfolio quality, that itself will be an important step. I think priority sector, I also think, yeah, the failure capital or credit guarantees, risk capital is also important. Uh, and within priority sector, if there are segmentation both around the size of the micro enterprise plus also the size of the NBFCs, because a lot of the innovation, to Puneet's point, will have to come from the younger new generation fintechs. And unless we are able to support them and get some of the policy benefits onto them, that is a challenge. The only other point I would add is that, today when we speak sometimes to the government officers, they feel there are a lot of schemes for nano and micro and none for small and medium. And everybody is, trying to say, how do you promote small and medium? Because that's where employment generation comes from. But I guess, yes, there are a lot of schemes. But I think, Shweta, you mentioned, or you mentioned, Mayur, that people are not yet aware of the schemes. So how are, both as a supplier of credit, but also as an aggregator of some of these schemes, how the NBFCs can play an important role in, ensuring that the right subsidies are followed. I think that also would be an important point. You want to, yes.
I want to just intervene here. There are schemes, but if you look at Mudra, it's not doing any addition. All they are doing is counting whatever NBFCs are doing under Mudra. And if you dissect that, again, the Shishu loans are much higher than the Kishore and the Tarun. So the higher the loan size goes, the lower the proportion of Mudra in that. We have to be careful. Huh?
Yeah, but and again, I mean, I'm saying we are using this forum also to say how the schemes can be tweaked. For instance, we were discussing over lunch that even the Mudra refinance is only available to the banks and not to the NBFCs. But if NBFCs are on lending to others, how do we ensure that some of those cost benefits of the Mudra scheme come up? I think there's the risk capital provided by SIDBI under CGTMSE scheme, but that also caps interest rates. So for NBFCs to be able to take benefit of that CGTMSE is itself a challenge because, at 18 or 19%, NBFCs find it difficult to lend. So clearly, a lot to be done. I would actually maybe just pause here and see if there are any questions. Okay, Vipin, you have 5 minutes. Okay, we will take 3 questions.
Can your mic be shared? Is there a mic available, or I'll just come in that case?
Good evening. Am I audible? Very enlightening session. Thank you all. I'm Dr. Valentina. I teach public policy in Ambedkar University. I wanted to ask about your research study, Abhishek. Did you look at the social composition? Women, Dalits, Adivasis? What is the composition? Is there a segment composition of these sectors? Because in India, caste and class generally go together.
Absolutely.
Thank you.
Absolutely. No, I think it's there in the report. I mean, we've limited copies for circulation. If anybody wants to collect them, they can do that. One thing about the social stratification, the social group split, was that almost 60-70% of the people were from the OBC background. SC, ST, we have a sort of a percentage as well, around 330 customers and around 78 customers ST. So yeah, we have those figures that can be seen in the report. So we have disaggregated data by gender. We have not disaggregated data by the social group yet, but yeah, at the time of the impact evaluation, that would be done.
Also from the report is, and Abhishek pointed to it, is that we saw all customers, the vintage was about 7 years. So again, talking about risk-taking ability, we still don't have, both new to credit is low, but new to enterprise is even lower. So, just saying how, if we want to also have innovation at the grassroots as a financial services ecosystem, how one supports all of that, that also becomes important. Any other questions? Otherwise, no. How do you want to do some? Okay, and I do know there are a few copies here. IFMR also wanted to take this opportunity to launch the report. So, if what is to be done?
Radhika, anybody from Access team, can we launch it?
Yeah, Vipin, why don't you come, Ridwanji?
Can we have a nice group photograph, please, with the launch of this? Thank you. Thank you for a very wonderful session, and thank Ms. Geeta Goel for your deft moderation of the session. We hugely appreciate your taking the time to join us for the panel, and thank you very much, panelists.